Corporate finance practice problem using OneNote. Cost of debt after tax problem 2. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side. We're in the practice problems area down here in the 115 cost of debt after tax Prob 2 tab. Also note, when using OneNote, take a look at the immersive reader. Many of our presentations up top will be down below as well. In the text area, same name, same number, having transcripts. They can be translated into multiple different languages and either listened to or read in them, thereby being a good complement to the presentations. Closing the tab, we have our information up top. We're going to go through that calculations on down below. We're talking about the financing options for an organization, for a company, for example. Those financing options typically being in two main categories: debt financing, equity financing. Focusing in here on the debt financing, remembering that when thinking about the debt financing, we also have to be considering the tax impact, because the major cost of the debt financing is something that impacts the income statement and therefore has a tax effect, that being interest. The cost being interest, that being an expense bad normally, but for taxes good, taxes backwards, taxes weird. Therefore, we have to consider the tax impact so that we can compare financing options from something like debt financing to equity financing, which doesn't have that kind of tax impact, have different kind of costs and benefits that we need to consider. All right, so we have our information up top. Company can issue the debt. The interest rate, we're considering annual rate here, 12%. The tax rate, 26%. Remember, when we're thinking about the tax rate, we have a progressive tax system. So you might say, hey, well, how do you get one rate there? Do we take the average rate or something like that? Note that oftentimes we're making a decision on the margin, as economists say. That means it's the last rate that we're looking at, because that's where we are at this point in time. We're paying the last dollar, highest rate, tax rate on it. Making a decision at this time at the margin means we're typically making a decision that will impact the highest tax rate. So we may then use that one, although it can get more complex and nuanced depending on the size and circumstance. Then we have the debt down below, the 100,000. We're going to do our calculation first, not considering the debt at all. And we're going to try to think about this basically saying, I would like to just look at the percentage cost and see if we can then compare that to different options up top and then consider the debt. It's often useful to add the debt in the calculation to better understand what the actual calculation is doing. So first we'll calculate it without the debt at all. We're looking for the cost of debt after tax. You basically want to memorize this formula, but you also want to know it intuitively. So we have the tax rate. We're going to say the 12% annually. Then you're going to take that times 1 minus the, not the tax rate. We have the interest rate, which is the 12%. Then we're going to take that times 1 minus the tax rate. There's 1 minus the tax rate, which is going to be 26%. You could think of it as 100% minus 26%, or 1 minus 0.26. That's going to give us our 0.74 or 74%. We're going to take that and multiply it times the 12, the interest rate, to get the 8.88%, thereby saying that after taxes, the percentage basically cost, the cost of debt after taxes on a percentage basis, is not 12%, the interest rate, but the 8.88%. And then we can compare that to other options, possibly helping us to compare it to options that don't have a tax impact, such as the equity options. If we consider this, then normally you want to kind of understand this, just memorize the formula, but also it'll be easier to memorize if understood. We're taking the interest rate. Normally the interest rate times the amount of the debt, if we're talking annual rate, would give us the amount of that we're going to pay. But then we have that's the cost of the debt. But then we have that tax impact. What's the tax impact on basically a percentage basis? Well, if we think about the change in the income statement, because we're talking about an income statement tax, we're talking about the change in the income statement, which is basically the cost of the expense. If we think about 100% of that minus the 26%, the 26% being the tax rate that we are then applying, that means that we're basically going to get like 26 back in some way, meaning we're going to have to pay it in interest, but 26% of it we're kind of getting back due to the fact that it's going to wash out in our taxes. We can think about it as the IRS kind of paying it back or lowering our tax bill by that amount. Therefore, the 74% is the amount that's actually going to be impacted, meaning we're going to have to pay for it and we're not going to get it back basically in taxes. You can think about it that way. So if we take the 74% times the 12%, we're talking about an after-tax impact of the 8.88. So when we're comparing to something that doesn't have a tax impact, such as financing through equity, it's useful for us to be comparing the same thing to the same thing using possibly the rate of this 8.88. So then it's useful then to think about this in terms of the 100,000. Let's plug the debt in. Oftentimes this calculation, people just memorize it, but they don't really understand it. If you then wanted to break it out in your mind, if you were actually to do this intuitively, you'd probably do something like this, which is worthwhile doing. You'd say, hey, let's just add a debt amount here, say 100,000, and calculate what the cost would be after tax on an actual dollar amount basis, and then see what the percent basis would be. So we could say, all right, well, if I just assume debt that we're going to have is 100,000, debt 100,000 times the cost of debt, the 12%, that's how much we're actually going to have to pay if it's an annual rate, meaning we're going to pay the 12,000. That's not good. Money's going out the door, the 12,000. That's the cost. That's the rent on us getting the purchasing power of the 100,000 by taking it from someone else who's willing to give it to us because we're going to pay the rent on it, which is 12%, dollar amount 12,000. Then we have the tax benefit, which is going to be the fact that we get to deduct this 12,000 most likely. And that means that we get the 12,000 times the 26%, which is going to be the tax rate that we're using at the margin, possibly then meaning the highest tax rate. The 12,000 times the 26% giving us the 3,120. So we're paying 12,000 to the debtor, who we borrowed from in some way, shape, or form. And then we're getting back, however, or lowering our tax bill by the 3,120 for paying it. So the 12,000 minus the 3,120 gives us the 8,880, which is the actual basically after-tax cost of the debt, not taken into, not on a percentage basis, right? That's the after-tax on a dollar basis. So then what is it on a percentage basis? Well, now we can say, all right, well, then we're just going to take that 8,880, that's the actual dollar value cost, divided by the original debt, 100,000. That then gets us back to the 888. There's the 888. This exercise is useful to do to better understand this. I recommend doing it in Excel multiple times. However, in practice, in book problems and whatnot, you'd rather not have to go through this whole process of making up a number or this or that and just memorize the formula. However, it's easier to memorize the formula if you understand the formula. Now, once you have this in practice, you might then ask the question as, what if we had this $100,000 debt? What would the cost, after-tax cost be? And I can get there more quickly. I'm looking to get to this 8,880 instead of doing this double kind of calculation. We can get there a little bit more quickly, which could be easier for us to do if we understand it intuitively. It could be easier for us to present. But if you do this, it also can be a little less intuitive. So if I was to present something, you might do it this way. We'd say, here's the debt, the 100,000, and then we're taking the cost of debt after taxes. We're multiplying it times that formula, which would be the interest rate times 1 minus the tax rate, or 100% minus the 26%, or the 74%. So interest rate times 1 minus the tax rate gives us then the 8.88. If we have then the 8.88, that's the after-tax cost of the debt times the 100,000. That then gets us the 8,880. So the same thing we did up top here, but a little bit quicker, because we did our quick little calculation that you kind of want to memorize here for it. Now, if you were to present this, I would present this, and if someone asks you, like, what does this mean in the middle? I don't understand this kind of calculation. It's a little difficult to calculate or interpret it, just with percents. If you then break out this calculation, then I think this is a little bit more intuitive just for anybody to basically see what is actually going on. So I would keep that in the back, of my slides or something like that. Have that ready if someone has questions about it, if it was something like that. So then if we do this again, let's do it again. Let's say the interest rate is 10%, the tax rate is 32%, the debt is the 100,000. First, we're going to calculate it just with the rates. This is the formula that you want to memorize. It's going to be then the interest rate, 10%, times 1 minus the tax rate. 1 minus the tax rate, or 100% minus whatever the percent of the tax is. So you could say 1 minus 0.23, or 100% minus the 32% is going to give us the 68%. And then we simply take the rate times that 68% would mean that instead of the debt costing us the 10%, which is actually the interest we will pay after taxes due to the tax benefit, we will then actually have an after-tax rate of the 6.8%, which we can then possibly compare to other options, possibly equity options, which don't have that same kind of tax impact, comparing then, as they say, apples to apples or the same thing to the same thing. Because comparing different things is not very helpful, useful, usually. Although it could be fun, I guess. But in any case, now let's do the same thing with the 100,000 here. 100,000, we're going to say here's the interest. We got the debt times the rate. That means that we would have then the debt of the 10,000. This is how most people would probably work this out in their mind if they were just doing it themselves and they're just saying, let me see if I can make sense of this. We're going to take the 100,000 times the 10% is 10,000. That's how much interest we're going to pay. And then there's a tax benefit because I get to deduct that 10,000. So then I get a tax benefit expense or a deduction times the highest tax rate, because we're going to say this is happening on the margin at this point in time. This decision's happening now at the end when we're already at the tax rate of the 32%. We're considering possibly our highest tax rate. 10,000 times the 32% means we're going to get lower bill of our taxes due to us taking on the debt of 3,200. So 10,000 minus the 3,200 means there's actually a cost in dollars of 6,800. But what's it in terms of a percent then? In terms of a percent, we would just say, well, then let's just take that cost of the debt after taxes, the 6,800, and compare it to the debt itself, the 100,000. 6.8 divided by 100 is going to give us then that 6.8 again, 6.8. This worth doing. I think it's easier, it gives you more information, or it's more intuitive, although longer. You want to memorize the formula, however, for practice problems and just make things easier. Let's do that same thing, the same calculation. I'm going to try to get to this number now, that the 6,008, but use our quick formula in order to get there. So if we say the debt is going to be that 100,000 debt, we'll just, instead of doing that two-step method, I'm just going to say, let's just multiply times the cost of the debt after tax percent, which is the formula of 10% times 1 minus the tax rate, or 100% minus the tax rate, right? 1 minus the point, it would be 100% minus 32%, or 1 minus 0.32, however you want to think about it. Multiplying 10 times the 0.68 then gives us the 6.8, and then I can get directly to the 6,800 instead of using a two-step method by simply taking the 100,000 times the 6.8. This is going to be a little bit cleaner to use something like this, possibly, if I'm comparing then multiple different options and trying to present multiple different options and analyze them and think about them and see what we want to do. So let's then do it again here. Let's do it again because this is fun. So next time, now we've got 8% on the rate, and now the tax rate is 40%. We won't think about the debt first. We're just going to think about our formula, the thing you want to memorize here. That's going to then be the interest rate is the 8%. Then we have the 1 multiplied times 1 minus the tax rate, 1 or 100%. This time we showed it as a percent, 100% instead of 1. 100% minus the 40%, or you could say 1 minus 0.4, is going to give us the 60%. 60% times 8 means that after taxes, we got the 4.8% actual cost of the financing. Even though we're paying 8%, we're getting the tax benefit, therefore 4.8. That means when we compare it to other options that don't have a tax impact, equity options, for example, possibly, then we possibly want to use the 4.8 to be fair between the options. And then down below, we've got the 100,000. Let's just try to do this intuitively and say, well, let's pull in the debt of the 100,000 and then recalculate what the actual cost would be in terms of dollars and in terms of percent. Let's do that. So we have the interest. The debt's going to be the 100,000. Interest rate 8%. We're going to be paying then the $8,000. It's going to cost us $8,000, but we get a tax benefit for taking on the debt because that interest is deductible. Tax benefit is going to be that $8,000 that's going to be deducted because it's on the income statement. And we have an income tax, and it lowers the income, taxable income, which lowers the amount of tax we pay. And we're going to say it's at the margin, which is a 40% tax. Man, 40%. So we're going to say then the 8,000 times 40%, that means there's a tax benefit of 3,200. So the 8,000 minus the 3,200 that we kind of get back, or we get to reduce our taxes by, means there's a net cost of the 4,800. So that's the net cost in dollars. But now let's compare that to the debt to figure out the percentage. I want to know what the percentage cost would be. So then we take that $4,800 divided by $100,000 debt, and that would then give us the 4.8% again. So we can do that a little bit more quickly now. Let's try to get to this number, the 4,800, by using our quick kind of calculation of the actual cost after taxes, percent calculation. So now we're then going to take the debt, the 100,000, pick up our cost of debt after taxes. This is the part you want to memorize, the formula you want to know. Interest rate's going to be the 8% minus 1 minus the tax rate, which is 1 minus the rate of 0.4 or 40% or 100% minus 40%. 8 times the 60 or 8% times the 60% is going to give us the 4.8. Then I can go directly to the end result here, taking that 100,000 times the 4.8 instead of taking the two-step method we kind of did up top to get to the dollar amount of the cost of the 4,800.